Welcome to the Retirement Wealth Podcast. Today, we're diving into something that's on a lot of people's minds: tax-free retirement income strategies.
Yeah, it's such an important topic, especially as folks start thinking about how to make their retirement savings last. And of course, how to keep more of that money in their pockets, right?
Exactly. We've got some great insights lined up today. We'll explore different strategies, like Roth IRAs and health savings accounts, and how they can help you create tax-free income during retirement.
And we'll also touch on the importance of planning ahead, so you're not caught off guard when tax season rolls around, you know?
Absolutely. It's all about being proactive, and that can make a huge difference in your overall retirement plan. Plus, we'll share some tips on how to navigate the rules and regulations that come with these strategies, which can sometimes feel a bit overwhelming.
Right, and we'll break it down. Keep it simple so that everyone can understand and feel empowered to take action.
So, whether you're just starting to think about retirement or you're already enjoying it, we've got something for you today. Let's jump into those strategies and start planning for the future you deserve.
So, Emily, when we think about retirement planning, it's really crucial to look at why these tax-free income strategies are so timely right now. I mean, we're living in an era where market volatility is just a part of our daily lives.
Absolutely, David. Just the other day, I spoke to a couple, let's call them Tom and Lisa. They were really concerned about how to protect their retirement savings from the ups and downs of the stock market. It's like, one week they're feeling great about their investments, and the next, they're worried sick.
Right, and that kind of anxiety can really take a toll on your overall well-being, especially when you're at that stage in life where you want to enjoy your retirement, not stress over your financial situation. That's where tax-free income strategies can really shine.
Exactly. And then there's inflation, which, let's face it, is eating away at purchasing power. I remember when my grandparents would talk about how much they paid for a loaf of bread back in the day, and now it's, shocking to see those prices.
Yes, and with prices rising, retirees need a plan that ensures their income keeps pace with inflation. I had a client, Mary, who was living on a fixed income from Social Security and some savings. When prices started climbing, she quickly realized her budget wasn't stretching as far as it used to. It was a real wake-up call for her.
That must have been tough for her. So how did she handle it? Did she look into these tax-free strategies?
She did, and that's the key. By incorporating tax-free income sources, like Roth IRAs or health savings accounts, she was able to create a buffer against inflation. It gave her the confidence to know that her income wouldn't be shrinking over time, even if prices continued to rise.
That's a smart approach. And let's not forget about the changes we've seen with Social Security lately. There's been a lot of talk about how benefits might change in the future, and that uncertainty can be really unsettling.
Absolutely. I've had clients express concern over whether they can rely on Social Security as their sole income source. You know, the idea that it might not be enough is scary. Planning for a tax-free income can really help ease those fears. It's like having a safety net.
Yes, and then, of course, there's healthcare costs. They can be huge in retirement. I had a friend whose parents faced unexpected medical expenses, and it really drained their savings.
That's a common scenario. Healthcare costs are rising, and many people underestimate just how much they'll need to budget for medical expenses in retirement. Having tax-free sources can provide that extra layer of financial security, allowing them to cover those unexpected costs without derailing their entire retirement plan.
That's so true. And it's not just about the numbers, right? There's also an emotional aspect to all this. Knowing you have a solid plan in place can really bring peace of mind.
Exactly. The emotional side of financial security is often overlooked. When people feel secure about their finances, they're more likely to enjoy their retirement, travel, spend time with family, just live life fully.
I love that perspective. It's about creating a lifestyle, not just a budget. And for retirees, having that tax-free income can mean more freedom to choose how they want to spend their time.
Right, and then there's the legacy planning aspect. Many people want to leave something behind for their kids or grandkids. If you can use tax-free strategies to grow your wealth, it can really impact what you're able to pass down.
Yes, and that can be such a rewarding aspect of retirement planning. Knowing you're not just securing your own future, but also providing for your loved ones.
It's a powerful motivator, And with current economic trends, we see that people are living longer, which means they need to plan for a potentially longer retirement. That longevity factor can really change the game.
Definitely. So much to consider, but if we think about it, those who are proactive about their retirement plans, especially with tax efficiency, tend to fare better in the long run.
That's a great point. By starting early and incorporating tax-free income strategies, they can build a more resilient financial future. It's about making those smart choices now to enjoy a stress-free retirement later.
And it all comes down to understanding the options available, right?
Exactly. And now is the perfect time to explore those options. With everything going on in the economy, it's more important than ever to be strategic about how you build your retirement income.
So, David, let's dive into some of those core strategies. What should our listeners be considering?
So, Emily, when we talk about tax-free retirement income strategies, one of the first things that comes to mind is utilizing tax-advantaged accounts, right?
Absolutely, David. I mean, accounts like 401ks and IRAs are practically staples of retirement planning. But what about Roth IRAs? They really stand out because, you pay taxes on the money before you contribute, but then your withdrawals are tax-free in retirement.
Exactly. With a Roth IRA, you can withdraw your contributions anytime without penalty, which is a great feature. And if you're over 59 and a half, you can start pulling out earnings tax-free too, provided you've held the account for at least 5 years.
That's a great point. And for many people, especially younger savers, contributing to a Roth can be a smart move because they might be in a lower tax bracket now compared to what they expect in retirement.
Right. And then there's the traditional IRA or 401k, where you get a tax break up front. You defer those taxes, but you have to be mindful of required minimum distributions, or RMDs, when you hit age 72.
Yeah, and those can really impact your tax situation later on, can't they? You're forced to take money out, which can push you into a higher tax bracket if you're not careful.
Exactly. That's why having a mix of accounts can be beneficial. It allows you to manage your tax liabilities more effectively in retirement. It's all about balancing the tax implications when you withdraw funds.
Speaking of balance, let's touch on asset allocation. A common rule of thumb is the 70-30ths rule, right? That's 70% in stocks and 30% in bonds for someone who's still in their accumulation phase.
Yes, and as you get closer to retirement, you might want to shift that ratio to something more conservative, like 60-40ths or even 50-50, depending on your risk tolerance. The idea is to protect your capital while still having some growth potential.
And let's not forget about real estate as a part of that diversification strategy. Owning property can provide rental income and has the potential for appreciation. It can be a nice hedge against inflation, too.
Absolutely. Real estate can be a solid long-term investment. Just remember, it does come with its own set of challenges, like maintenance costs and market fluctuations. So it's essential to do your homework before diving in.
Yes, and then there are annuities, which sometimes get a bad rap, but can be a valuable part of a retirement income strategy if used correctly. They can provide guaranteed income streams for a set period or even for life.
Right. Fixed annuities can offer predictable income, while variable annuities can have growth potential but come with more risks. It's about finding the right balance that fits your overall retirement plan.
And let's not overlook Social Security optimization. It's crucial to know when to claim your benefits. Delaying your claim can increase your monthly benefits significantly, especially if you can wait until age 70.
Exactly. Each year you delay past your full retirement age increases your benefit by about 8% annually. So for many people, it makes sense to delay if they can afford to do so.
It really does. And when you combine that with a smart withdrawal strategy, like the 4% rule or the bucket strategy, you can create a solid plan that minimizes taxes while maximizing your income.
The 4% rule suggests that you can withdraw 4% of your total retirement savings each year and potentially last for 30 years. But, of course, it's not one size fits all. Some folks might need to adjust that based on their specific situation.
Right. And the bucket strategy, which divides your assets into buckets for short-term, medium-term, and long-term needs, can help manage market volatility and ensure you have cash available when you need it.
Exactly. It gives you a structured way to withdraw funds, reducing the pressure to sell investments in a down market. Plus, it can help you maintain a steady income stream throughout retirement.
And while we're talking about income, let's not forget about tax savings techniques that can really enhance your retirement strategy. Strategies like tax loss harvesting can help offset gains.
Yes, and charitable giving through a donor-advised fund or making qualified charitable distributions from your IRA can also be tax-efficient ways to give back while reducing your taxable income.
Those are great strategies. And it's all about being proactive, right? Planning now can help you avoid surprises later on.
Definitely. The more you know about your options and the potential tax implications, the better prepared you'll be. But it's also important to regularly review and adjust your plan as needed.
For sure, and it's easy to get overwhelmed with all these options. Between different accounts, investment strategies, and tax implications, it can feel like a lot.
It can be daunting, but that's why having a comprehensive plan is essential, so you have a clear roadmap. And working with a financial advisor can really help clarify things and keep you on track.
That's a great point, David. It's about finding a trusted partner who can help you navigate these waters.
And, despite all the strategies and planning, there are common pitfalls that people can fall into when it comes to retirement planning.
Oh, absolutely. I think we should definitely dive into those next. They can really derail even the best laid plans if you're not careful.
So, Emily, one of the common pitfalls I see with retirees is this idea of sequence of returns risk. It's when the market takes a downturn right when you start withdrawing money from your investments.
Right, and that can be super damaging, especially if you're relying on that income, huh?
Exactly. I had a client, let's call him Mike. He retired in 2007, right before the financial crisis. His portfolio took a hit, and because he was withdrawing funds to live on, it really compounded his losses.
That's so tough. So what should people be aware of to avoid that situation?
Well, it's crucial to have a strategy that prioritizes income generation, especially in those early years of retirement. You want to have a cushion, some safer investments that can sustain you if the market dips.
That makes sense. It's like having a safety net for those first few years, right?
Exactly. And then there's the issue of taxes. Many retirees underestimate how taxes will affect their withdrawal strategy.
Oh, totally. I can see how that could be a surprise. How do people typically overlook that?
Well, they often focus on their gross income without considering their net income after taxes. For example, if you withdraw from a traditional IRA, that's taxable income. I had another client, let's call her Sarah. She was shocked when she saw how much of her retirement income was going to taxes.
Wow, that must have been eye-opening for her.
Yeah, and she had planned for a specific lifestyle, but with those taxes eating into her funds, her budget got really tight.
So what's the key takeaway here?
Understanding your tax situation is critical. You want to plan your withdrawals smartly, maybe even consider tax diversification with Roth accounts or other strategies to minimize that tax hit.
That's really helpful. I think a lot of people might not even realize how much they should be thinking about this.
Right, and then there's healthcare costs, which can be a massive surprise. Many retirees underestimate those expenses.
Oh, for sure. I've heard that healthcare can eat into a retirement budget pretty quickly.
Exactly. I had a couple, let's call them John and Linda. They didn't account for increased healthcare costs as they aged, and they ended up spending a significant amount of their savings on out-of-pocket medical expenses.
That's a scary thought. How can people better prepare for that?
Well, it's essential to factor in healthcare costs into your retirement plan and consider long-term care insurance or other options. Plus, don't forget about Medicare and what it covers.
Definitely. It sounds like planning for healthcare should be a priority.
It really should. And then there's longevity. People are living longer these days, and many retirees underestimate how long their money needs to last.
That's a big one. I mean, if you retire at 65 and live to 90, that's a long time to fund.
Exactly. I had a client named Tom who thought he'd be fine with a 25-year plan, but he actually ended up living into his late 90s. His funds started to dwindle, and he had to adjust his lifestyle significantly.
That must have been tough for him.
It was. And it's a reminder that planning for longevity is crucial. You want to ensure your investments have the potential to grow and sustain you throughout retirement.
So what can retirees do to spot these issues early on?
One red flag is if you're constantly worried about your finances, or if you're changing your lifestyle dramatically to make ends meet.
Yeah, that's a clear sign something might be off.
Right, and if you're not reviewing your withdrawals and investment strategy regularly, that's another red flag.
So staying proactive is key, huh?
Absolutely. Regular check-ins with a financial advisor can help you adjust your plan and ensure you're on track.
That's great advice, David. What about asset allocation?
Ah, yes. Poor asset allocation can lead to unnecessary risk or missed growth opportunities. I had a client, let's call her Grace. She was too conservative with her investments, mostly in cash and bonds, thinking it would keep her safe.
And that didn't work out well for her?
No, it didn't. With inflation eating away at her purchasing power, her savings weren't growing at all.
So she was losing money in real terms.
Exactly. A balanced approach that aligns with her risk tolerance and time horizon would have been much more beneficial.
What do you recommend for someone who might be in a similar situation?
It's essential to have a diversified portfolio that includes stocks, bonds, and perhaps some alternative investments, depending on your risk tolerance. You want to make your money work for you, not just sit there.
That sounds like a smart approach.
It is. And of course, let's not forget about Social Security. Many people claim too early, which can significantly reduce their monthly benefits.
Oh, I've heard that can make a huge difference over time.
It really can. I had a client named Mark who claimed at 62. He was eager to start enjoying retirement, but he lost out on thousands of dollars because he didn't wait to claim at a later age.
So what's the best strategy there?
Ideally, if you can afford to wait until your full retirement age, or even up to age 70, you'll maximize those benefits.
That's super important to consider.
Yeah, it's all about making informed decisions. So, to wrap up this part, the key is to stay educated, review your financial situation regularly, and be proactive about adjustments.
Absolutely. It's all about planning and being aware of these potential pitfalls.
Exactly. And for those who might find themselves in a tough spot, there are always strategies to recover or adjust.
That's a great point. What would you suggest as the next steps for someone who's listening and is concerned about these issues?
Well, the first step is to take a hard look at your current financial situation. Review your income sources, your asset allocation, and your withdrawal strategy.
Sounds like a solid plan.
And don't hesitate to reach out for professional advice if you need it.
Great advice, David. It's so empowering to know that there are steps you can take to create a more secure retirement.
Absolutely, Emily. It's all about being proactive and informed.
Thanks for sharing these insights. I think our listeners now have a better understanding of what to watch out for as they plan for their retirement.
All right, so let's dive into some immediate steps folks can take, right now to start implementing these tax-free income strategies.
Yeah, absolutely. It's all about actionable steps, right? So what would you say is the first thing someone could do?
Well, I'd suggest beginning with a solid review of your current retirement accounts. A lot of folks might not realize the tax implications of what they currently have. So sit down, maybe grab a coffee, and take a good look at your accounts.
That makes sense. And if they find that they need to make some changes, what tools can help them with that?
Great question. There are some really useful online calculators out there. For example, Vanguard, Fidelity, and Schwab all offer retirement calculators that can help you project your income needs and see how tax-free accounts might fit in. It's super user-friendly.
Oh, I love that. And those calculators can really help clarify how much you might need to save, right?
Exactly. And don't forget about SSA.gov. It's a great resource for estimating your Social Security benefits. Knowing what you can expect there can really help you plan better.
Right. And what about tax software? Any recommendations?
Absolutely. Using tax software like TurboTax or H&R Block can help you get a better grasp of your tax situation. They often have features that allow you to simulate different tax scenarios, which can be really beneficial when you're exploring tax-free options.
That's a great point. And I feel like it's crucial to have that understanding before making any big moves. Now, what about financial planning apps?
Yeah, there are quite a few out there. Apps like Mint or Personal Capital can help track your spending and investments. They provide insights into your financial health, which can be super helpful as you strategize for retirement.
And it's always good to have a clear picture of where you stand financially. So what habits should someone consider adopting, even if it's just a small step?
One habit I always recommend is to review your portfolio quarterly. It doesn't have to be overly complicated, just a quick check-in to see if you're on track with your goals. You can ask yourself, am I still comfortable with my asset allocation?
Definitely. A little check-in can go a long way. And running retirement projections regularly is another good practice, right?
Yes, absolutely. It's like recalibrating your GPS. You want to know that you're still heading in the right direction. It can help you adjust your contributions or investments if needed.
And for anyone who feels a bit lost, are there any books or podcasts you'd recommend for them to dive deeper into this?
Sure. A couple of great books are The Simple Path to Wealth by J.L. Collins and Retire Inspired by Chris Hogan. Both offer solid insight into building wealth and planning for retirement.
Those sound fantastic. And what about podcasts?
Well, I'd suggest checking out The Retirement Answer Man by Roger Whitney and Choosy FI. They both cover a lot of ground on retirement planning and strategies, plus they have a really engaging style.
Sounds like a treasure trove of resources. Now, what about the mindset aspect? Is there a habit people can adopt to keep them motivated?
Oh, definitely. Start small. Even just setting aside a few minutes each week to think about your retirement goals can make a difference. It keeps your mindset focused, and it's never too late to improve your plan.
That's such a reassuring thought. Just taking those small steps can lead to big changes over time.
Exactly. And remember, every little bit counts, whether it's reading a chapter of a book, checking an account, or just thinking about your goals. It all builds on itself.
So those are some practical first steps. Now let's bring this all together.
Well, Emily, that's quite a bit to unpack from our discussion on tax-free retirement income strategies.
Absolutely, David. I think one key takeaway is the importance of understanding how different accounts are taxed, right? Knowing the difference between taxable, tax-deferred, and tax-free accounts can really help in planning.
Exactly. And another point is the power of Roth IRAs. Those tax-free withdrawals can make a huge difference in your retirement income, especially if you plan ahead.
And don't forget about the benefit of using life insurance as a strategy for tax-free income. It's not something everyone considers, but it can be quite effective.
Right. And then there's the whole idea of timing your withdrawals, too. Being strategic about when you take money out of your accounts can minimize your tax burden.
Yeah, it's all about being proactive, isn't it? And remember, diversifying your income sources can provide more stability during retirement years.
Absolutely. It's really about building and protecting your wealth so that you can enjoy your retirement without financial stress.
So, listeners, as you think about these strategies, remember that planning is key. You have the power to shape your financial future.
And if you found this episode helpful, please take a moment to like and subscribe. Also, we'd love to hear from you. Comment with your biggest takeaway or any questions you might have.
And don't forget to share this episode with someone who's planning for retirement or already in it. You never know who might need a little guidance.
And next time, we'll dive into a really interesting topic. Should you pay off your mortgage before retirement? It's a critical question for many.
It sure is. We'll explore the pros and cons, so you won't want to miss that.
Thanks for joining us today, and we look forward to chatting again soon.
Take care, everyone.